Good afternoon, people. Hope you're well and you can hear me. Welcome to this week's or this month's webinar, How to Remove Your Emotions from Trading. Without further ado, let's get straight into the pith of this. And let's go straight forward. Read the disclaimer. And okay, in this webinar, we're just going to discuss how to remove emotions from trading. This is something which a lot of people find very difficult to do, especially when we're all got a vested interest essentially in money. Money is finite, it's scarce, and when you see or are witnessing or experiencing the prospect of losing money, it can be very painful. Whereas in trading, a lot of people, certainly who've been or are well seasoned in the markets, will tell you that losing the trade is necessary to win the battle, i.e. losing the battle is essential to win the war. Okay, so what we're going to do is discuss how you can remove your emotions from trading through devising a very particular style of trading and really going for high reward to risk. But I just really want you to empathize and have a kind of like a zone of introspection. Okay, how does trading actually make you feel at the moment? A lot of people, when they're new to trading, feel fearful. They're fearful of winning after a losing streak. They're attached to the outcome of the trade. For example, if they've seen a really good setup and it looks, it fulfills all the rules, and of course, there's huge expectation amongst most people who've traded it to win regardless. A lot of people are doubtful of their strategy, certainly after a string of losing trades. And a lot of people, certainly the majority of people who don't really seek professional mentoring or training, end up feeling angry and frustrated because they do not know what they don't know. And this is absolutely key. Okay, so these, all these components to what is essentially a vicious circle, a vicious cycle, causes self-sabotage. It stops people from entering trades which fulfill the rules, approach anxiety, people who do actually place trades. And if they actually do win, then they cut their winners too early. I think everyone's experienced a bit of that. If they've had a losing trade, then they'll happily take or unhappily take the full loss. Okay, it's that old adage. If the market's moving against you, you're willing to watch it go against you until you take a full hit. But if the market's going in your favor and you just want to bank a small profit, you do, but it's never enough to make up the amount lost on the previous trades. Okay, and this is where ego comes into it. All right, so that causes you to erode your trading account, essentially with 1,000 paper cuts, and lose money, and essentially gets you even more angry and frustrated. When trading actually, when mastered correctly, should actually make you feel calm, patient, and disciplined, confident in your strategy. Of course, if your strategy is not successful and hasn't got a good track record, then what is the point of trading it? That's the billion-dollar question after all. We should not be outcome attached to our trading. We should accept that the market can do anything at any time, and who are we to declare a winning trade when the market can just do its thing regardless? Okay, we get paid for turning up over a long period of time through following our rules and through being patient and disciplined, and only trading setups which fulfill our criteria. Okay, so I repeat, the market does not owe us. I know that when we've gone on some kind of educational course or program, or even tuned into certain webinars, you might feel that, hey, I've done a bit of work here, I've spent half an hour in front of my charts, I've done all this market analysis, but you know what? I deserve to trade, and I'm going to place a trade no matter what. And it's this mentality, this kind of feeling of entitlement, which really gets people, especially newbies, into a lot of trouble. Because, as I said to you before, and I'll tell you a billion times again, shouting from the rooftops, the market doesn't owe us anything for just wanting to place a trade. It doesn't give us a setup in exchange for spending like an afternoon in a seminar. The market doesn't give us a winning trade just because we decided to do our market analysis. Opportunities are random. So too are winning and losing outcomes of these opportunities. All right, so please remember that. A lot of people, again, with the fear of losing and the self-flagellation that is experienced from a losing trade, they end up just so fearful of losing more that they just give up when actually the strategy is profitable, and through not trading, they've missed out on the winning opportunities. So that's fear of success. And what people should really feel and appreciate is that losing the battle is part and parcel of trading in pursuit of winning the war. Okay, you might get a couple of losing trades, 3 or 4 losing trades in advance of like a huge winning trade, or a long string of winning trades. That's the thing. Okay, so this kind of calm and peaceful way of trading, like it should be, should cause you really only to take setups that fulfill your rules. You should accept that anything can happen at any time, and you shouldn't really have a sense of entitlement. You got to appreciate the frequency of opportunities is completely random, like buses turning up in London. That you can lose small and win big if you risk manage and you go for setups with high reward potential. That's the big one. Causing you to make money in the long term and enjoy all the benefits of trading consistently profitably over a decent period of time. All right, so a number of you might be asking, okay, what is this guy on about? How is this possible? I want to know the answer, and don't worry, I'm going to tell you just now. All right, so what we need to do in order to really remove our emotions from trading is separate our hearts from our head. Okay, we need to really put things into a logical perspective here. This is absolutely essential. Like I mentioned at the beginning of the webinar, to many people, money is scarce and it's very finite. This is why we're emotionally attached to it. And to a varying degree, the more you earn, the less attached to the money you are. But if you're really putting yourself under pressure to trade and you've got a tiny trading account and you're trying to double it because you've decided that, hey, this is the answer to get me out of all my financial woes, then you're going to be very emotionally attached to the outcome of the trade compared to someone who's just put $20,000 in a trading account. They're just thinking, well, I'm going to give this a go. I'm going to follow the rules, but you know what? 20 grand is a lot of money to me. That's the difference. Okay, so they'll have somebody who is trading with money that they can afford to lose, which essentially everyone should do. Not that we intend to lose it, of course. They'll invariably have a much less of an emotional attachment to the outcome of the trade, and that's absolutely essential. It will cause trading, the act of trading, to be far less of an emotional roller coaster. Okay, so let's talk about how we can remove our emotions from trading. There are several ways we can do it, all combined. It's quite a powerful way, modus operandi, if you like. All right, so first things first, have realistic expectations on trading, okay? It's not a get-rich-quick scheme. Slow, incremental, consistent gains over the long term rather than trying to double your account overnight or even in a week or even in a month, okay? Let's just be real here. Please do not trade with money you cannot afford to lose. Any financial advisors out there probably will have, or anyone who has seen a financial advisor out there, not that this is advice, by the way, would split up all of their income into varying degrees of risk, low, medium, and high risk. Trading is a high-risk activity, so any money which you can afford to lose, even though obviously we don't intend on losing it, then that should be allocated to trading. Do not go remortgaging your house or anything like that. Something silly. I've heard of ridiculous stories like that before, and it's just desperate, it's greedy, and it's just completely not what you should be doing, especially before you've got a track record of trading, okay? I know I'm the first one to admit I made every single mistake in the book several times over before becoming consistently profitable, and anyone who has trodden a similar pathway will say the same. But, some people just want to force it, and this is not how we do it. Patience and discipline is key. I know it might sound like a cliche, but it's so true. Never risk more than 1 to 2% of your account's value on a trade. This is essential. You get trade setups and there are trade setups. Sometimes even the best looking trade setups out there, those picture perfect, Mona Lisa looking trade setups which fulfill all of your rules for entry, which, according to the charts, just nothing can go wrong. And you feel like you should place more money on it, and you break your rules, and they, of course, bomb. Then who's to blame? Of course, it's you. And of course, even those picture-perfect setups just sometimes don't work. That's the thing. That's opportunity flow. And what we do as traders is we look at the net sum of all trades over a sample of trades rather than just doing it in a trade-by-trade basis. If you're going to ditch your strategy after one losing trade, then maybe trading is not for you. You need to give every strategy, providing it fulfills your lifestyle and your availability to trade and your risk aversion, then give it a sample of 20 trades or so over a period of 3 months. Okay, so never risk with more than 1 to 2% of your account's value, because any more would be just reckless and greedy, and we don't want to trade like that. We're professional traders. We're not have-a-go punters. All right, so trade setups with positive reward to risk. We'll talk about that a little bit more later. It's say, for example, you're risking a small amount in pursuit of a far bigger amount than you risked. Use a stop loss. That is a critical. If you don't use a stop loss, you might as well just, get some dynamite and blow a hole in your trading account, because all it takes is one losing trade for you to wipe out your account, and you really don't want to do that, because that means that you're out of the game very quickly, and you'll be out of the game before you've even learned what you've done wrong, and you'll probably just give up and not want to even talk about trading ever again, understandably. Okay, so letting your winners run. This is, again, something which is, according to the strategy, we always let our winners run, because certainly if they're the trend, who knows when the trend's going to bend, okay? That's the beautiful thing about trends. We piggyback them, and there's no end in sight until we get a reversal pattern on the time frame we've traded it, or indeed we get some groundbreaking news or policy announcements which really do kind of scupper the trend. Okay, so these 6 steps here give you the framework in which to essentially remove your emotions from trading. You keep the risk low, you keep the reward high, and you're not forever checking your trades out of exasperation, thinking, oh my goodness, I risked £100 on this trade. This is a lot of money. It has to be right. Goodness, I need this money today. I've given up my day job to trade, and I need to make money every day. That's the worst kind of thing you can do, especially on a smaller trading account before you're consistent. It puts you under pressure to trade. It puts you under pressure to find trades which aren't there. You overtrade. You trade out of boredom, anger, and frustration, which again is a vicious, horrible cycle. All right, so this is why I always say, keep trading simple, easy, straightforward on the hard time frames, rather than having this horrible pressure of, giving up a day job and trying to be a millionaire on a £10,000 trading account, because it's just not going to happen. Okay, it's laughable when I hear people who come to me and they say they want to make something like $25,000 a week with their $1,000 trading account. It's ridiculous. Absolutely ridiculous, but it is quite funny, and I was one of those people who used to be there back in the day, so I'm not going to laugh too much, but certainly, as I said to you before, I learned the hard way, and I wouldn't want any of you in this webinar today to do the same thing. This is why I'm teaching all I know on the subject. All right, so let's talk about how we can implement this in practice. I see a few familiar names here. Let's have a look. FX Boyke, yes, I see you. I know a number of you. There we go, I see familiar faces. Anyway, so how does this work in practice? I was just scrolling down the list of attendees. Let's move on. So have realistic expectations. This is absolutely critical. You see a lot of these kind of like misguided adverts out there which try and lure you in with kind of like, you've seen the computer spitting out wads of cash in these images and montages of like Ferrari parked outside your mansion on, in Miami, and all of this. If only you can give the company with the advertisement a couple of $1,000s in receipt of some kind of bottle, something like that, which apparently is going to double your account. If it's too good to be true, it generally is. So just as I said to you earlier, trading is not a get-rich-quick scheme. The market does not owe you anything just for turning up, and it certainly doesn't owe you anything for actually doing your market analysis. Just accept that's part and parcel of trading. Even if there's nothing to trade, you still have to do market analysis and look to see what's available. All right? Remember that not being in the market, a decision to not be in the market, is a valid trading decision. You've made a valid decision not to put your capital at risk. And as a lot of people don't realize when they're new to the markets, is capital preservation is the first objective of any trader. The second objective is to make money. Okay, the number of strategies you trade does not equal more money, i.e. the more strategies or the more trades you place does not equal more money. Losing the battle is part of winning the overall war. Okay, you can make as much money or as many pips trading a strategy which yields you only 3 to 5 or let's say 3 to 10 setups a month on the daily time frame as you can trading intraday. But the great thing about trading the daily time frame, of course, is that you do not spend as much time trading it than you would if you're intraday trading. And when you're looking at a time versus money return, if you had a winning month, then if you're trading the daily time frame, you've had a much better time return compared to if you've traded intraday, if you've got the same result. Conversely, if you've had a drawdown for the month, people who trade intraday versus people who trade end of day, the people who traded end of day would have done better, because at least if they drew down like the intraday traders, they would have spent far less time doing or sustaining that drawdown. Okay, so remember, whatever happens, slow and consistent gains can be made over time if you have the right edge, risk management, and the winning attitude. Know your strategy and when not to trade. I mentioned that, and I'll mention it again before we all depart as friends in about half an hour's time. So risk management, moving on. This is critical. Again, I know a number of you are probably familiar with this, but it doesn't mean that it's lost any of its raison d'etre, since you probably had the last person talking about it. We need to treat our trading account as our fund, as our business, essentially, and we should never trade with more money than we can afford to lose. I'm sure you've heard me say that before, and guess what? I'm going to say it again just in case, because a lot of people, they say repetition is the key to success, and even if you do find me repeating myself, then it's that kind of hypnosis. It's like those advertisements on the radio you get where they mention the brand name they're promoting like 50 times in the space of a minute. It's bloody annoying, but you know what? It gets some message drilled into the listeners. It really does. Okay, so we want to treat our trading account as a business. Our key ulterior motive is to make money after we've preserved capital. Okay, and we can do this by risk management, keeping our losses to a minimum, i.e. the money placed on a trade, so if it loses, we only lose a small amount. But if we're in a winning opportunity, then obviously we want to make those winners run. So let's talk about risking 1% per trade. Well, here's the formula. If you want to screenshot of this, or email me afterwards if you want the slides, that's absolutely fine. It's rob@thelazytrader.com, by the way. So anyway, working out 1%, you should never risk more than 1 or 2% of your trading account. So if, say, you've got a £100,000 trading account, you should never risk more than £1,000 on any trading decision, no matter how good it looks, okay? Because imagine if you risked 10% on a trade setup and you thought it looked absolutely amazing, it fulfilled all the rules and it lost, then you're going to get that real kind of horrible recency bias for when you get setups which fulfill the rules and you don't trade it because your most recent trade lost money and you risked a lot on it and lost a lot on it, but you don't take the next trade setup which fulfills the rules, and typically it wins. So always assume that the market could do anything at any time. If the market goes against us, we don't lose more than 1%. I'm just going to close the window because police car outside is really starting to annoy me. There we go, that's better. It's not really. Anyway, so the formula is 1% of our trading account. Say we've had a £10,000 trading account, 1% of that is £100. So if the worst thing that happens is that we lose the trade, we lose no more than £100. Okay? So in order to find a stake size, how much we place per pip or per point, we have our entry price minus our stop loss price. The difference, it could be, say, for example, 100 pips difference between our entry and our stop loss. If 1% of our trading account is £100, then we divide that 1% of our trading account, £100, by the difference between our entry price and our stop loss, okay, to find our stake size. And that's how we trade size. That's a crucial element. All right. Moving on to a stop loss, which is very closely related in terms of like preserving capital. It's a special set of orders we have with our broker, which means that if the trade goes against us, we do not continue to remain in the trade. The broker automatically takes us out so that we do not lose any more than 1% of our trading account. I mean, I'm going to ask you, you're not going to go bungee jumping without a cord, would you? So it makes sense to obviously trade with the safety of a stop loss just in case the market goes against you. Remember what I said, even though those picture perfect trades can go against us despite fulfilling all the rules for entry, and that's exasperating when that happens, but you just got to lump it, unfortunately. It's part and parcel of trading. Some do lose us money, and when they do, the trick is obviously not to be dispirited when you get the next setup, because sod's law, those people who get dispirited when they have their picture perfect trade go wrong. They don't trade the next setup because they're suffering from recency bias, and of course the next trade is the winner, which makes a lot of money, and they're not in it. And that's a typical newbie's paradigm, really, and just take it from me, that's not a nice dilemma to be in, really. Okay, so trade strategies with positive reward to risk, that is pretty essential. In fact, that's very essential, especially when you're trading on the hard time frames. This is a lot more tenable on the hard time frames like the daily or the weekly. The reason is because these time frames are a lot more resistant to news announcements or intraday spikes. It's not going to be the case that you're going to be stopped out like you would be if you're trading something like the 5-minute, God forbid, or the hourly or the 15-minute. So just take it from this perspective, that trades yielding a good reward are our lifeblood, and it means that we can still make money even if we have more losing trades than winning trades. So let's go back to here. I never like trading with negative reward. I'd rather go for, if I'm risking 1% of my trading account, I want to know that I'm getting at the very least a 2-to-1. So that I'm risking 1%, i.e. £100 of my trading account, that I could stand to gain potentially £200. A lot of people just go for 3-to-1, which is absolutely fine. So they're not going to take a trade setup unless they've got the potential of making 3% in exchange for their 1% risk. Okay, so remember that high reward to risk trades as well, they're not immune to news, but the great thing is with news that news can either go in favor of the trade setup or could go against it. And nobody knows the whole time what direction the news is going to go in. It's very difficult to predict news. Some people get it right some of the time. Nobody gets it right the whole time. So that's the great thing about news of our trading. If it goes in favor of our trade setup and we've got a 3-to-1 trade with the potential of making 3% when we risk 1%, and news is in our favor, 50-50, then it could help perpetuate a winning outcome, i.e. make us 3% return on our trading account. If the news happens to go against us, 50-50 chance that it could, like I just mentioned, then at least we know that we risk or stand to lose no more than 1% on that. So that's the important thing about looking for trades with high reward and news as well. Okay, so we can always determine the reward to risk of a trade prior to entering, but it makes a lot of sense to obviously deduce this based on the realms of possibility rather than what you want the market to do. And this is absolutely important, essential actually. I'm going to show you a few examples in a minute of how we can conservatively deduce what the reward potential is when we're placing a trade. Okay, and we do this based on past nuances in the market. Okay, so yep, the difference between what is possible over and above fantasy, very important indeed. A lot of people will typically, well, certainly students in their early years, there's a bit of a kind of disconnect between what is actually possible in the market based on technical analysis versus what they actually want to happen. And, we're very good as human beings at kidding ourselves in this sense. So the reward to risk equation, there we have it. We have the difference between our entry price and target price divided by the difference between our entry price and our stop price. Okay, and I know it looks very kind of empirical here. They're just numbers and kind of box outs, but I'm going to show you a few examples here. For example, this is the EURGBP. We actually took this one in June this year. It was a really nice trade, and a number of our clients took it as well. We saw a inverse hammer here, the difference of 67 pips difference between our entry and our stop loss. And we knew that even if we took it just off the bottom of this range in the daily time frame, there was 246 pips potential gain. And we knew that 246 pips divided by 67, i.e. 246 pips potential reward in exchange for 67 pips risk, we knew that 3.6 to 1 is a great reward to risk. So, for example, if we had a £10,000 trading account, the worst thing that can happen is that we're wrong and we lose $100, risking 1% of our £10,000 dollar trading account. But if we're right and the market does go away, then we could potentially make $360 or pounds if it goes to our target. So we know what the worst possible thing that can happen if we're wrong, which is far overridden by the best possible thing that can happen if we're right. All right, and of course, the technical argument behind this trade setup was biased in favor of a sell for those people who want a bit of a roundup. Well, I'm going to go through it to the charts in a bit, but just look at this top of the range, top level of resistance. We had bearish reversal divergence in the RSI setting 6. We had an inverted hammer or bearish pin bar reversal. Evening star, whatever you like to call it, it's basically an open and close in the bottom third of a bar of a tail, testing a level of resistance here. And it looks like it's coming to the top of a intermediate range here. Complex retracement, one might call it, looking at the bigger picture. So that's EURGBP and how we're deducing reward to risk on that one. Looking at pound Aussie, this is how we essentially traded this one with high reward. This is a trend-based trade, and we took this one at the time, or at the period of the elections this year, my apologies, in May, when it was the Tories versus New Labour, or Old Labour with Ed Miliband, and we placed along here this bullish pin bar reversal, also known as a morning star, low test bar, whatever you call it, and we had a difference of 186 pips difference between our entry and our stop loss. That's our risk. Our potential rewards, the target was the previous swing high because the pound versus the Aussie is trending upwards. And quite frankly, a good conservative target is the previous swing high or just in advance of. I know this target will take, well, I knew back then this target would take quite some time to be hit, but it doesn't matter. It was a set and forget trade, and it was on the daily time frame. And if the Tories won, which they did, we knew the markets would love that, and it would help perpetuate this winning trade. And of course, the next day, the election results were broadcast or revealed, and of course, David Cameron won. Thank goodness. So, yep, that was a good reward to risk trade. Please, there's a bit of a mistake here. 246 pips isn't the actual number of pips. It's actually 838. So I'm just going to make a correction on that one. So my apologies for that. So as you can see, 838 pips potential reward divided by 186 pips risked. That's a 4.5 to 1 reward to risk trade. So again, if you had a 10,000 US dollar or pound trading account, the worst possible thing that can happen if it goes against you is that you lose 100 pounds or dollars. But if it goes in your favor and the trade is won, then the best possible thing that can happen if it hits target, and you could potentially make 450 US dollars or pounds depending on your trading account's denominated currency. So that's the power of reward to risk, and that's why I always place trades which have positive reward to risk, because I want to be rewarded far more handsomely if I'm right than what I stand to lose if I'm proven wrong in the market. All right, so just to bring it all together, it's absolutely essential to be realistic to yourself and be fair to yourself with those expectations. Trading is a long-term activity, and you should really be conservative. Don't set yourself weekly targets in profits, because that forces you to place trades which might not otherwise be there. And of course, the mind will play tricks on you when you look at the chart, thinking, oh, there's a trade set up, even though there might not be one. For a profitable strategy, generally the simpler the strategy, the better it is. I know it's something which I tell people and they look at me in disbelief, but funnily enough, it's okay. Strategies, many of which are as old as the hills, but it's the trader's propensity to stick with the strategy and trade it medium term or long term and stick to it through thick and thin. That's the test, okay? And you should be patient and disciplined in your approach. Trade with money then you could afford to lose, that will remove the emotional attachment to the outcome of the trade quite massively. Keep the risk small, i.e. 1 to 2%. Use a protective stop loss. If your broker does not offer this, then I'd encourage you to move to a broker who does. Any broker who doesn't offer the stop loss, quite frankly, I don't think it has any clients who will be on their books for very long, because most people do blow up if they don't use a stop loss. It's actually a statistical likelihood, a statistical certainty. Sorry. So, through having a calm, disciplined, patient approach where the risk is small and you don't have an emotional attachment to the outcome, will turn trading into a calm and patient, disciplined pursuit. You'll be confident in your strategy and your approach. You'll be non-outcome attached, appreciating that the market could do anything at any time, and you'll be optimistic that if you're right, you'll be rewarded very handsomely compared to if you're proven wrong. You'll be penalized by the market by a very small amount. Okay, so it's just the nature of the game. And I would like to emphasize it is a game, but you just have to know how to play it. Okay, you shouldn't treat trading as entertainment. That's the irony. It might be a game, but don't treat it as entertainment. Treat it as a business, and that's the crucial element to it. Okay, so I'm just going to talk to you about some trade setups, which we've taken throughout the year. I just want to talk to you about that EURGBP one, which we took. There we go. So I just want to really just show you, we'll give you a snapshot as to how we trade and what opportunities we see. Okay, so at this bearish pin bar reversal here, all the way back in June, we had on the RSI bearish reversal divergence. You see here the RSI made a lower high, whereas price action made a higher high. That's a sign to us that the bears are creeping back into the market and the bulls are starting to essentially get less pronounced in their strength. So what we did was we placed an order to sell just below the low here, stop loss above the high, and as soon as we were in profit by the equivalent distance between our entry and our stop loss, I think it was about 46 pips. Let's have a look here. Then we had about 56 pips difference between our entry and our stop loss. As soon as we made 56 pips, we moved our trade to break even for a no loss outcome, and then we just hit target over the course of June, and then it was all very straightforward and nice, basically, the outcome. Very straightforward. I'm going to talk to you about the dollar CAD trade we're currently in. This is one which I've been in for ages. I know, so I don't know if any of my clients are in at the moment, but you probably, there's a likelihood that you'll be in this trade. And it was this week here mid-June actually, we had this bullish pin bar reversal, and we had a very aggressive, well, not very aggressive, but we had a relatively aggressive entry for this one, where we had bullish pin bar reversal. Like I said, we placed our order for a long. It's a trend-based trade, so we were safe in the knowledge that, okay, the 20 is above the 50, the 50 is above the 200, so we knew that we could objectively deduce this is still an upward trend despite what one could argue is a lower high here. It doesn't really matter. We just viewed this as complex retracement. So order above the high of this week's bar, stop loss below the low of the week, which triggered or took out the high of the bullish pin bar reversal bar, and then we took it up to the previous swing high here, scaled out half the position, and we've got still half the position running at the moment, and we've just been dithering in this trade for quite some time. 1, 2, 3, 4, 5, past 5 weeks, this market hasn't really done anything, which is absolutely fine. On the daily, we're just simply waiting again to buy the dip. If we get the bullish pin bar reversal here, we can see how well it's tested the 20 moving average and the angle and the separation we have between the two moving averages. Then we still an upward trend, making key higher highs and higher lows. So we're just waiting for our bullish pin bar reversal here before we can add more to our position for a long. We're currently at 1% long on the weekly. We've been in this trade for weeks, but it's made us a really good gain on our trading account. And we haven't really had to do much in terms of manage this trade. It's been very, 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 very straightforward. And that's exactly how trading should be. Very straightforward, without any kind of nonsense. Here's one. We're currently in this one at the moment. We traded this one this morning. This is CAD yen. And this is what we call a smash bar. Bullish pin bar reversal closing into a level of support in a downward trend is actually a very decent, safe exit for a sell trade, because what caused this to low test yesterday, bears were trounced by the bulls. The bulls came charging into the markets when price came down to this point here. But today, the market has breached the very point where yesterday the bulls charged into the market, causing it to low test. But today, that level's been broken, proving to us that the bulls, which initially defended the level, are no longer there to do so. So this is why we have placed an order just below the low of yesterday, stop loss above the high of yesterday, and we're looking to take it down to the previous swing low here for a good, easy 2-to-1 trade. Might take a few days to come to fruition, but no, it's a straight trend-based trade. And if you look here, we've got good order angular separation. We've got old support here becoming new resistance. We've got a decent round number, 92. It all correlates quite nicely. You've got a confluence of reasons for a sell here. And, if it works out, great. We get a nice high probability 2-to-1 trade outcome. If it goes pear-shaped and it goes against us, then we lose only 1% of our trading account. Okay, so that's one which we're currently in at the moment, just about. We just placed a trade earlier this morning. So in CAD, talked about CAD. FTSE, well, FTSE is an interesting one, isn't it? Could say a bit of a basket case. We are just looking to sell the rally. That's the thing, that's the important thing about FTSE. We can see that the moving averages got the 20, 50, and 200. So we're in a downward trend now, officially. We've broken this key level here, 6100. We're just looking to sell the rally. And that's what we should do really in a downward trend. Sell the rally or buy the dip in an upward trend, just like we did with dollar CAD. That's absolutely crucial. Okay, so this is a nice trend-based trade. I know last week, my apologies, we low tested, closed within that zone here, but quite frankly, on the daily, that is a more accurate picture of what is going on with the current news being absorbed into it rather than the weekly at the moment. Okay, so that's currently what we're in. We're giving you a more relevant trade idea. Those of you who Aussie Swiss, sorry, we actually traded this one as well. We mentioned this one as a potential trade idea for our audiences in our Market Insider webinar. We just saw this typical sell the rally here. Got horizontal level. There we go, horizontal level retracement. Had a doji bar here, bar of indecision. So we did talk about the potential of clients placing their orders just below the low here, stop loss above the high, and trail any kind of move off the back of that. And they're currently up about 0.75% if they risk 1% on their trading account, or 0.75% if they risk 2% on their trade. Okay, so that's a nice textbook setup, really, and there are plenty more of those on the horizon. And certainly when we've got a period of risk off, i.e., equity is falling, sorry, my mic just fell out there. My apologies. Okay, so going back to this, we have a question and answering session very, very soon. But I just want to ask you the one question which might be hot on your lips is, if you would like to transform your trading into a carefree and relaxing hobby, then listen up, because we can definitely help you to do so. And it's the difference between your money, your new working. So if you want weekly timeframes, the hard timeframes, and just simply set your trades and forget, then this is where we can really help you enjoy your time as a lifestyle trader and get you to consistent profitability. And as you've made the effort to come to this webinar today, we're doing something a little bit special for you in collaboration with FX Street. And what we want to do is give you access to our flagship mentoring area, the Ultimate Program, which has attracted a lot of attention lately. And we've got, a very rapidly growing client list. And, we've had 2 new coaches as well. So it's valued at $1,997. Our online price is here. But what we want to do is give you a test drive for $30, which is, nothing really. So you've got nothing to lose really for just having a look and seeing what you think. Okay, so that's the Ultimate Program. And of course, you might be asking, so what's in it for me? Well, what isn't there for you? There's everything. We can give you weekly market analysis with our Market Insider webinar. We'll give you an amalgam of 40 years plus in the markets. Our coaches have a combined experience of 40 years. We've got 10 hours plus of training videos, all very concise and growing. We've got a forum for you to network, meet and mingle, talk trade setups, pattern recognition software, countless bonuses, like we've got a trader hypnosis audio course, which is going down very well. And of course, we'll share our trade ideas with you as well. I mean, we trade what we see, we trade what we think, and of course, we share with you what we're trading. So that's proof of the pudding that what we do works. Okay, so in order to get your 88% discount, all you need to do is go to www.thelazytrader.com/forex-training, buy the Ultimate Program, read the terms and conditions, and use the promo code FXStreet9. in lowercase. That will generate your discount. Okay, so if you're not happy, you can get a refund. It's absolutely nothing for you to lose for doing this. Okay, we've taken on all the risk, so just come and enjoy the service with us, and yeah, hopefully we'll see you on the other side. And that's this offer is only available until midnight tonight, so please do sign up quickly before it runs out. This is midnight London time. Okay, so hopefully see you on the other side. We've got a few questions. There we go. I'm just going to get it up for you. I'm going to answer the questions which are in the chat window. Let me read them out so you can see my screen. How do you let your winners run? Ray, that's a very good question. I generally scale out. So I have a conservative target and I have a slightly more aggressive target. So what I do when I reach to my conservative target is I take off half the position and I just let it run to my more aggressive target. And I'm quite aggressive at trading my stop loss there. I'll do a webinar on this actually because it's something I will struggle to discuss with no real examples in 3 minutes with respect. So I'll make a note of that and we can do that later. Okay, so Durav, that's a similar question. Hopefully I've answered that for you. Maylor, how many currency pairs do I trade? Well, I trade all of them, May, just because it's an exotic or foreign-looking currency pair. It doesn't mean that I don't trade it. I view currencies, well, regardless of where they are, what they're from, in exactly the same way as I do stocks or commodities. I just trade according to what I see on the chart, not what I think. Okay, how can I control euphoria of fear? Well, it's very easy, this one. I always say to myself, well, what is the worst possible thing that can happen if I take this trade versus what is the worst possible thing that can happen if I don't take this trade? Okay, so the worst possible thing that can happen to me if I take the trade, if it doesn't go to plan, is I lose 1 or 2% of my trading account's value. The worst possible thing that can happen to me if I don't take a valid trade setup, and of course it runs without me and I lose money, is of course I miss out on a really nice profit. And that's the downside, of course, missing out on a nice profit on a trade setup which fulfills all your rules to entry because you're too fearful of taking the trade. Okay, link to slides. Email me, fxboyke, please. rob@thelazytrader.com. Mr. Islam, drinking cool water. Yeah, that's a good idea. Another question, how to control fear of the market, not going to target, therefore getting out at half. Well, yeah, I mean, you know, it depends how you want to do it. I mean, I always have 2 targets, target 1 and target 2. When it reaches target 1, I take half the position off and I go to target 2. If it doesn't get to target 2, I'm stopped out with that extra profit denied. All right, so that's my answer to your question. If you've got any more questions, do drop us a line and let me know what they are, and obviously I'm very happy to answer them. But for now, I'd like to thank you all very much for coming. It's been great talking to you. Some really good questions in the webinar, and I will say happy trading and hopefully see you as members of the Lazy Trader this evening. Thanks, guys.